Alrighty, let's get this show on the road. Everything should be good. Hello, nice to see you. Ari and I are actually hanging out in the trading room on Discord. So after we do this bit of Outlook here, we're going to be hanging out in Discord going over some Aussie-related trade plans. Do a little bit of focus work in the trade forum, covering the fuel shortage there. So, particularly looking forward to doing that after the stream. And then, actually, you were doing some research too on some crypto stuff. I don't know how that's been going, but if it's been going well, it's been going well. Sometimes it takes a while to do stuff. And then, yep, hey, Ari. It's very nice to see you two hanging around, seeing this stuff. Now, this report here that I'm about to bring up on the screen, this is something that is in the trade group. So, what I did is I took all of my notes for the past 3 months, and I got an AI to make not just a summary. See, so many prompts when it comes down to doing financial analysis, they say, oh, summarize this 30-page report for me, and it'll try and summarize it for you, and then it'll miss half of the important shit. So when I do my notes and I curate the important things that I want to keep track of and stay updated on in my notes, and then ask AI to read the last 2 or 3 months of notes and then find trends, read the analysis, read the future expectations in those notes, and then to extrapolate forward, I find that this is very likely going to be a much higher quality, you could say, AI summarization than most other approaches. Also, it's a lot cheaper for me to do this because I already have a lot of this analysis. I have all my notes are local on my machine, so it's really, really easy for AI to just scoop it all up proper, which also means I can funnel additional information because I read through this and there's a couple, it's about 90% of what I want. And that remaining 10% is mostly geopolitical analysis that's missing. And I realize that's mostly because there's not as much data on the geopolitical analysis in the notes. So that's one of the things that I hope that the research threads will hopefully help out with, because I can actually take the data from research threads maybe once a week and create summaries out of this, but it's going to require us to leave commentary in threads. So, it's one thing when we have 10 or 20 posts and we're just bombarded with news, and there's all these posts that get made in the research threads. After realizing this, started to be like, well, maybe I need to post like a message or two about what I'm thinking, or how I am interpreting a particular X post, or how I'm particularly interpreting a specific article. And then that should make the job a lot easier for the AI to summarize and extrapolate, because I don't find summarization terribly useful unless you're just trying to get caught up with the latest information. I want extrapolation. I want outlooks, right? I want scenario analysis. And that's primarily what we're going to be doing today. So over here on the right, we have the summaries that we'll be going over. But as we go down these summaries, we're also going to be bringing up charts using some tools from the trading group. Yep. It's good to take a break. So I saw your message. It's very, very good to take a break. So with that all said and done, let's get now into this first segment, there are sections here. In this very first section, we can read the executive summary, and it is relatively good, I'd say, at least in summarizing what's in the document. But again, we need to judge this not based off of how it has reviewed the sum total of all the information it has been given, but we need to judge this based off of how well it extrapolates our current expectations forward. Now, things are developing on a day-by-day basis news-wise. So if enough changes in a single day, politically, geopolitically, with the Strait of Hormuz or whatever, you can very easily end up with these expectations becoming dated and not very useful if things change very, very quickly. So it's important to just keep that in mind as we go through this, that we have to be flexible to new information. And then we're going to be judging this based off of how well the expectations in this document actually hold up. So that's going to be the determining factor of whether or not this is a process worth continuing to work on going forward. So we have the DXY open here on the left, and the reason why is because a lot of this is regarding the US. So right off the bat, the global macro landscape has shifted dramatically with the US-Iran war, otherwise known as Operation Epic Fury, triggering the largest oil supply disruption in history. And then we'll turn down the music just a little bit here because we don't want it to, again, too loud and you can't hear me sometimes. Okay. The Strait of Hormuz, carrying roughly 20 million barrels per day, 20% of the global oil supply, faces persistent blockage, creating stagflationary headwinds. Simultaneously, monetary policy divergence has emerged as the dominant theme, with the RBA hiking aggressively, while most G10 central banks remain on hold or cutting. The US dollar debasement narrative that dominated early 2026 has temporarily reversed amid safe haven flows, though structural US dollar weakness remains the consensus medium-term view. And especially that latter half of the summary, I think, is much more explicitly correct on what the current expectations are for things like the dollar and central banks. So I am quite happy with at least the expectations set in the second half of that paragraph. And you can see very, very clearly at the beginning of the year, the dollar fell through, right? The dollar actually fell from here to here in January, 3.25%, or 3.75%, 3.75 percentage points. And since then, it's just been recovering about 4.5% over the last roughly 2 months. So you can even see after, once we got into late November into December, that theme really, really, really piled on. Okay. I feel like I got something in my eye. Anyways. I was quite happy to see this chart here. And I will make it a tad larger. So this is the monetary policy divergence section. New normal. This is the rate trajectory matrix for 2026 to 2027 based off current expectations. These are definitely subject to change depending on especially energy prices over the rest of this year in 2026. So starting off with the first row, the FOMC, its current rate is 3.5 to 3.75%. And for 2026, we're expecting 1 to 2 cuts in June and September. However, this is now already starting to get pushed out as the likelihood of the conflict in Iran with Operation Epic Fury ending is currently expected to occur around May. And the month that comes after May is June. And it would make sense to expect you would need energy prices and inflation to normalize again if, let's say, by May, the conflict is resolved. So the FOMC may already be on hold here. So we can already see that the information here might not be totally cutting edge, because now we're getting much more hawkish information. And we're also going into a week where many of these central banks are going to be giving their updated analysis. The FOMC is actually giving their SEP analysis, and that's their projections. That includes the dot plots, which very likely are going to, I think, be much more hawkish. So very, very likely in the next week, these expectations will be brought up higher, brought up to be more hawkish. And you can see the direction is currently cautious easing, and it'd be reasonable, I think, to say the direction is now hold. Now we have the RBA, which is 3.85%, 1 to 2 hikes in March and May. And this is still currently expected. And they are actively tightening. So that's good, I think, so far. ECB, current rate is 2%. Hold through 2027 is the consensus view. And they are on a hold as well. Bank of England, 3.75%, 1 to 2 cuts in April and November. That might be getting pushed out further as well here. Gradual easing may not be on the table if energy prices rise again. The BOJ current rate is 0.75%. One hike is currently expected in October, which is still the consensus, I believe. And the terminal rate is 1 to 1.25. Now, there are some analysts that are actually expecting 2 hikes from the BOJ this year. So we'll see how Japan's energy prices hold up, because they are a huge importer of energy and they can be quite price sensitive to energy costs. And this is saying slow normalization. This is just gradual hiking, is the way I interpret this direction. Now on to the RBNZ, 2.25%, hold, potential hike in December, I believe so, and then the current expected terminal rate is 3.25%, so about 100 basis points higher. I think most of that is expected actually in 2027. And then delayed tightening, yeah, that seems to be the current view. Then Bank of Canada, current rate is 2.25%. Cut in Q2. Hold is the expectation as of the generation of this document. Terminal rate is about 2%, back to easing. I think this might change, because even though Canada is a net oil exporter, there's still going to be inflationary pressures that are outside of Canada's control. Because as much as Canada exports to the United States mostly, they still import a lot from China. They still import a lot from Europe. They still import a lot from the United States. And if those places have higher manufacturing costs, those costs can be passed down onto Canada, which will increase inflation in Canada. So when global inflation rises, just because inflation in your country isn't going up, doesn't necessarily mean that the markets around you going up won't also impact you, as a kind of a rising tide lifts all boat situation. But this is like a rising tide lifts all the boats, and you're adding waves on top of it. And Canada just so happens to be in the trough between some pretty fat waves where the other countries are sitting at. So the key insight here, the era of synchronized global easing has ended. Australia leads the hiking cycle amid sticky inflation. Trimmed mean at 3.4%. That's their inflation. While Canada faces recession risks requiring renewed cuts. And these risks are being mitigated because of the growth expectations in oil. However, a lot of these recession expectations are due to the jobs markets in the eastern provinces of Canada. The ECB sits comfortably at neutral, but risks are asymmetric. Euro strength and energy shocks could force cuts, while persistent services inflation could trigger hikes in 2027. The other end of this is also continuing to provide economic support to Ukraine as long as the war conflict, however you want to put it, with Russia, the war with Russia, is currently going on with Ukraine. Right now, there's a huge issue in the EU regarding this because Orban of Hungary has, I believe, with one other country, if I'm not mistaken, but it's mostly Orban, has blocked, I believe, $90 billion worth of euros in military aid to Hungary because of a dispute with I believe the Duras pipeline. It's called the Friendship Oil Pipeline in English, which is actually quite ironic because the relationship between Hungary and Ukraine right now is not very friendly. Hungary wants to purchase Russian oil. They have an exemption from the EU as an inland country to purchase oil from Russia. But it's quite rational for the Ukrainians to say, we actually are not going to facilitate these oil transactions for you by pumping the oil through pipelines that go through Ukraine. So we are going to shut down this pipeline. There was an excuse that the pipeline was actually damaged to prevent sending the oil. However, third-party investigations of the pipeline to check up on its status have been denied, even though aerial footage I haven't seen the aerial footage, the satellite footage myself, but it's reported that there's actually not significant damage that's preventing the pipelines. And then the other way that Hungary can actually get their oil is through Croatia. Now, what does this have to do with the euro strength and the ECB? Look, if Ukraine does not get that money, now you don't have this huge stimulus. This 90 billion euros is effectively a military stimulus that can actually help manufacturing, because while the loan goes to Ukraine, the money is going mostly back to European countries. It's a loan to Ukraine, but Ukraine is then spending it back in Europe to purchase manufacturing equipment, huge military buildup. So it's a bit of an economic stimulus. that's expected to follow through from that. So the longer that gets held up, the longer that gets delayed. And the further the change in growth expectations that the ECB sets for the euro area gets put on pause for. Because first we actually need to see that money not just be sent to Ukraine, but then sent back, and then we need to see the follow-through that can take a few months of companies actually stepping up production from that income, from that stimulus. It's in a very similar vein to the stimulus that was passed in Germany. And a lot of analysts also see that stimulus as just not being enough. So this 90 billion euro is supposed to kind of spread the money out throughout Europe. So it's a big, big deal to understand this conflict with the pipeline, because it would just be very easy if Orban voted for this package, but he's not. Excuse me. And effectively provided that stimulus for most of Europe. However, Orban has just had, I think yesterday, a massive, massive, massive protests and massive rallies because he's going into an election, and oil and energy being cut off like this and the prices of all this stuff going up, 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 and up is putting all this additional pressure on the people in Hungary and Slovakia. Slovakia is impacted by this as well. In fact, the research thread in Discord on this particular geopolitical event is the Slovakian-Ukraine oil dispute. Now, if these countries don't get their energy resolved, it's going to make them continue to want to dissent. The rest of the European Union, and actually von der Leyen, said that they want to work around Orban's veto. So the rest of the European leaders are trying to work around Orban and find a way to get this money through, even without his vote. And there's a lot of factions involved in actually trying to promote Orban's opponent, who is expected to vote for this package, vote to grant Ukraine this military aid. So there's a lot of push from outside of Hungary to get Orban's opponent in, but still there's a lot of Hungarian nationalists who rightfully also don't want to have an energy crisis, and they want someone who will essentially, quote unquote, fight the world to get that energy in. And you know what? Energy is just very, very expensive for Hungary right now. They can get their oil through Croatia, but they stopped pumping oil through Croatia into Hungary and Slovakia because, at least according to a Wikipedia page, the cost was about 3 times higher than what they were getting with Russian oil through the pipeline when it was coming through Ukraine. So and that was before the Strait of Hormuz incident. The 3 times price was already before everything shut down at the Strait. So the energy situation in Hungary is actually quite bad. There's massive protests going on. And depending on how that election goes in April for Hungary will determine whether or not that military aid goes through. And if that military aid goes through, we're expecting massive stimulus throughout most of Europe. And then that's going to lead to financial analysts watching manufacturing and all sorts of service PMIs to see what the pass-through is from that 90 billion euros being sent to Ukraine and then effectively sent back, on what kind of economic output that's going to generate. And then that will change the ECB's expectations. And so when I say that this report covers about 90% of what I want to cover, you know, that's about the 10% that I'm talking about that is generally missing here. Those geopolitical aspects. However, those things are not mentioned in most outlooks. Those things are not mentioned in most reports. So I don't get to write about that sort of stuff in my notes very frequently, but I can, if I want, just to just show for a sec. There's this thread here on explicitly this. And we can make it full screen. We can make it big. Slovak Ukraine oil dispute in the research forum. And you can see this is the video, March 15th, the Peace March speech. Orban was there. There are all these people. I mean, it was a big thing in Hungary. It was a big thing. That's a lot of people. That's a lot of people. Quite low resolution video. Let's let it buffer, but there's a lot of people there, and obviously there's a hint of propaganda in that, right? There's a hint of propaganda in that, because who bought all the flags? Obviously, very likely Orban's party bought and supplied all those flags to the protesters. But you know what? The people still showed up. A lot of people still showed up. So, not to totally derail the continuation here, but now we will start moving on to the next section after this. So this is a... Oh, that's right. I have to do, I believe, silence the notifications. That's right. Market pricing has shifted from expecting cuts to pricing and hikes for several G10 central banks. So that's what this shows. This is a chart from SEB that is one of my favorite charts that they provide. And this goes over on a month-by-month basis which central banks are having meetings and what the current rate hike or rate cut net expectation is. So for the FOMC, you can see that the first glimmer of a rate hike in a meeting you get is really in June, about 9 points out of 25 priced in. It's a bit under half. You could call it a little more than a third, right? About 40, maybe closer to 40% odds of a hike here. And then this is a bit over 50%, so you'll call it 60% odds, actually, of a cut here. These are cut odds when you see negative. And then hike odds are in blue with positive. You can actually see the RBA over here, right? We read this, hey, they're expected to hike. So I expect more of these odds to become more flat, to become... to move more into a hold position, and for a handful of these to more clearly move in the direction of a hike. So RBA is moving in that direction. The BOJ is moving in that direction. The Risk Bank is moving in that direction. The Swiss Bank is moving in that direction. And let's see here. Well, it's actually quite nice to see the SNB moving in that direction, because people were wondering whether or not they were going to go into negative rates again. So let's continue on here. So now we're in the next section. Oh. And the next section here is oil. And the markets did just open for oil. We're sitting at $96 right now. We opened at $100.93, and we traded up to $102.44 on crude oil seal futures. And now we've fallen from the open about $1.70, $1.75. So from the high to the low, we're talking close to $5-6, depending on how you round the pennies. So here we have oil shock. This is the next section here, number 2. Oil shock and inflation, the stagflation specter, energy market disruption analysis. The baseline scenario for oil with a roughly 50% probability. Conflict resolves in weeks. Brent averages about $90 a barrel. And we can kind of scoot this over a little bit so we can see a bit more of the chart. Very, very nice. Brent averages $90 per barrel in Q2 before falling to $70 per barrel by Q4 as inventories rebuild, with all these SPRs getting released. The IEA is releasing 400 million barrels. However, it's not really the IEA. It's all these economies, part of the IEA, agreeing to release those barrels. Global supply loss is 3 to 4 million barrels per day initially, recovering by year end, and that's 50% odds. Now, this is already, I think, an old scenario, because right now oil supply from Saudi Arabia, I think, has been cut back 8 million barrels per day just in Saudi Arabia. And we're starting to see more oil facilities have shut-ins. And it's once you have a shut-in, it's not so easy. It takes a couple of weeks, depending on the facility, to closer to the end of 6 weeks to really get a facility back up, supposedly after a shut-in. Adverse scenario is a 30% probability. Prolonged Hormuz closure. Prices spike to $130, $150 a barrel, with 6 million barrels per day offline. Recession trigger, real income contraction, back-to-back negative consumption quarters, financial conditions tightening. So we're partially in this adverse scenario. We already have about this million barrels per day offline, 6 to 8 million. But oil prices, especially crude, have not jumped up to this price. You can see right now we're at 96. However, Middle Eastern oil is trading at around 130. So depending on the oil you're looking at, if you're looking at Brent or WTI, you can have different oil prices. And right now, WTI is still pretty affordable, but the issue is there's so many VLCCs and long-distance tankers that are being held up right now around the Red Sea and on the other side of the Strait of Hormuz in the Persian Gulf that are unable to contribute to oil deliveries around the world. So it's not just that oil supply is being held up, it's all the crews and all of the ships that are currently on the other side. And then all the ships that were waiting to cross into the Persian Gulf through the Strait of Hormuz that have just been sitting on their hands this whole time and now have to redirect and either go around the Cape of Good Hope or try and go through the Suez Canal or go back the other way to just go back to port, probably in Asia where they came from. So there's a lot of, you could say, rebalancing of the logistics of a lot of ships that had plans to go through the Red Sea or go into the Persian Gulf or to just stay around that area that now have to be and are still being continuously rerouted. And so costs are adjusting based on that. And insurance is also changing based on that. And it's not making pricing oil any easier at the moment. And it's definitely not making it easier for oil purchasers to figure out a steady cost and, frankly, to also get a steady supply from various places. So now we have the extreme scenario here, 20% probability. Multi-month closure of the Strait of Hormuz. Prices breach $200 a barrel, which is actually what the Iranians are threatening that they want to try and achieve as far as their part economically in the war, in Operation Epic Fury. That's what they want to achieve on their end economically. Central banks forced into 200 to 200 basis point hiking cycles to contain inflation expectations. Now, I think that's going to be a bit less likely. Reason being is that many analysts, and I expect in the upcoming minutes and upcoming speeches from all these central banks over the next week and 2 weeks, are going to state that they are willing to look through short-term inflation rises over the next few months. Guys, we are now going back to the idea that we had in COVID from the FOMC of transitory inflation. Now, back with COVID, that inflation was sure as hell not transitory. However, this inflation, depending on how long the Strait of Hormuz stays closed, the number of drones, ballistic missiles, rockets that are launched from the Iranians, and the state of military transport vessels for tankers through the Strait and around the Persian Gulf, whatever the state of that is going to significantly help with determining those inflation expectations. So if things get prolonged past May, it's going to have much more serious issues for inflation that are not transitory. And we could end up with central banks hiking into weaker economies and higher inflation. And that can cause recessions in many parts of many economies. But this, I think, is an example of getting ahead of expectations. Because you can clearly see this says central banks forced into 200, 250 basis point hiking cycles to contain inflation expectations. This is a risk that occurs about 3 months out from now. And there's many things that can happen in the preceding 3 months from now that can lead us into other scenarios. So this is definitely getting ahead of expectations. This is one scenario where this is an over-extrapolation. There's this intermediary step where, well, first we have to get to that point, and then this risk can potentially realize. And before we get to that point, things seem like they are more likely to normalize. That seems to be the baseline expectation. And I believe if we scroll down just a hair here, there's actually this picture here. And this is a picture of, I believe, a Poly market, prediction market, yeah, it's right there. Probability of U.S. Iran ceasefire by date, only 2% chance by March 15th, which was yesterday, so that market is over. Rising to 62% by June 30th, suggesting prolonged conflict in the base case. So all these analysts that are currently expecting the conflict to be resolved, and by quote-unquote be resolved, doesn't necessarily mean that the fighting stops. For a lot of these analysts, resolved just means that traffic through the Strait and into the Gulf, and for tankers to load and unload oil and other commodities safely, and then transit that to wherever their destination is, that normal sea returns in the Gulf by around May. So fighting can continue for Lord knows, either transitory government in Iran or civil war could occur. What these analysts are mostly focused on is, do we have normalcy economically in the Gulf by May? Because we can look through 1 or 2 and at the edge 3 months of higher inflation pressures. But once you get past that, it gets harder for the central banks to justify not to hike in order to protect their economies against higher inflation costs. So we have time to figure out what the solutions are going to be by world leaders in trying to resolve this conflict and in trying to get us to that objective, at least economically. Will there be a ceasefire in Iran? Well, right now the odds are about 56% by May, by the end of May. But for us and for trading purposes, we're looking at this as a proxy as to roughly when will there be some kind of normalization in the Persian Gulf to allow commodities trade to continue. Okay, let's scroll back up and continue going down. So these are the oil price scenarios here. Westpac oil price scenarios, historically Brent crude with baseline and 3-month Strait of Hormuz disruption scenarios. Current March baseline shows spike to $90 to $110 per barrel. And Brent crude is this one here on the left. And oil's been falling quite a bit here. Oil so far has fallen about 5% here. About $5 going into today. So I wonder if there's been any news announced here that's been particularly beneficial for oil supply at the moment. Let's see here. I need to quickly refresh the stream. Okay, everything looks so far so good. So Hormuz, 3-month Strait of Hormuz disruption. That actually goes up to $125 here. If I zoom in here. Oh. We want to go up here. Yeah, you can see this a bit more clearly. So this is the 3-month disruption right here. And that's 125. And then the purple one is the March baseline. And green is February baseline. We have already gone back up. You can actually see on this chart, we've already gone back up past $100 here. So maybe this is the March baseline they're expecting us to hit. We will see. This, for all we know, this could just be a higher low. Because I don't know if anything has quite changed yet. We can go ahead and check the news and see if anything has changed materially. White House Press Secretary Leavitt, Trump and Vance will launch task force on fraud. Let's see here. Trump spoke with many countries in the last days, speaking with allies. Oof. Excuse me. Oh, Canadian CPI came in lower than forecasted across the board for year over year, month over month. Real quick, let's actually check out dollar CAD in response to that news. Well, dollar CAD right now looks like it was appreciating in favor of the Canadian dollar going into this, and it seems like it may have found a low for the day. But given, yeah, and that was right around here. Yeah, we just got that news. This is actually quite good to see this inflation, this disinflation coming in. This is actually quite nice to see. Given that there are inflationary risks around the corner that Canada might be in for. Let's see here. Treasury, U.S. Secretary of Treasury Bessent made some speeches just now. And there's going to be a U.S.-China trade statement in the next few days. Any actions addressed to prices depend on duration of war. I'm not seeing anything particularly great here that would imply that we have any new information to change our expectations for oil to go higher at the moment. So even though we've fallen over the last 4 hours, I've seen no new news, anything new to update our expectations on this front. So we'll go ahead and continue from that segue. And onto this section, inflation impact by region. All right, I was particularly happy when I saw this because there were kind of throughout many analysts very disparately placed and spattered about analyses on these forecasts for higher inflation. And we can go by row here. For the United States, inflation is about 2.4% before Operation Epic Fury. And if inflation were to, let's say, go past that 3-month time horizon where we can see more serious positive inflationary effects from higher oil prices, higher energy prices, and in general, just trade disruption occurring, we can see inflation rise about an extra % in the United States. And then second round risk is moderate. I'm not exactly sure what the quote-unquote second round risk represents here. These are a couple of just side notes of where inflation could continue rising faster. For the euro area, before Operation Epic Fury, inflation's about 2.1%. And post, it's expected on about a 2-3 month time horizon, if there are continued energy issues, to rise about an extra %. And that is definitely in line with the analysis that I've read. For the UK, it's about 0.5% to 1% rise that's expected if things continue to worsen. For Japan, it's about 1% higher. But if you do see something like $150, $200 per barrel oil, you could see Japan get explicitly much higher. It could get pretty bad. Also, spring wage negotiations are just around the corner, and those wage negotiations are, by consensus, expected to come in much, much higher. That was one of the things I was hoping this document would catch when it came down to connecting the inflation jump in Japan, not just connecting it with the rise in energy prices that are expected, but also with the expected rise also in the spring wage negotiations. And it didn't quite catch that. But yeah, Japan expected to see at least a 1% rise in inflation if things continue to worsen from here. And then you have Australia. Australia looks like it has a 1.5% rise expected. And with the RBA hiking, in order to try and tamper down inflation, it seems like, and we'll be going over this actually after the stream in the Discord. We're going to be going over the fuel shortages currently going on in Australia and get some more information on how to essentially trade around the Aussie dollar after the stream here. And that's a nice bit of information to look at. It puts Australia at greater risk than some of these other countries right now. Same thing with New Zealand, similar 1.5% rise expected if the energy crisis worsens. Now you have the central bank dilemma. The Fed and the ECB will, quote, look through temporary energy inflation, but sustained over $100 per barrel oil risks de-anchoring inflation expectations. Market pricing has flipped from expecting cuts to pricing in hikes for the second half of 2026. And then here's the energy share of CPI by percent. So this green area here, right here at the very bottom, is electricity, and then you have petrol, then you have gas and other. And you can see for the euro area, it's a huge percent, close to roughly 8%, 7% of their CPI is due to electricity and petrol. Japan's about 5% for energy and petrol composing of their CPI. New Zealand is right on par with the euro area, somewhere between 6 and 7% for petrol and electricity. Sweden also between 6 and 7%, and Australia is right here between 5 and 6%. United States also between 5 and 6%. So a lot of these economies are going to have a higher volatility to energy prices. So that's going to be New Zealand, Sweden, the euro area as the top ones. Then I believe it goes United States, Australia, Japan. Then it goes Canada, Norway, the UK, and Switzerland at the very bottom. So those are the countries from greatest to least that are likely to have the largest impact on their future CPIs, the highest pass-through of energy prices to their CPIs. Oh, wow, check that out. Oil is continuing to fall quite aggressively. So let's see here. Is there any more news? No, I do not see. It's nice to see oil falling, but I would like to certainly know why it's falling. Yeah, and the Iranians are saying that they have not asked for a ceasefire. No messages have been exchanged with the United States. So I'm not quite certain. Maybe this is a mechanical move. And by mechanical, I mean maybe someone is excuse me, taking massive profit. Maybe there's some information that hasn't come down the wire yet. But to see such a strong move in oil on the day, when I haven't seen anything come through the wire, kind of unusual. Maybe this is governments intervening and dropping on the open market SPR. Some SPR reserves. Well, it's a bit redundant to say SPR and reserves because the R in SPR stands for reserves, strategic petroleum reserves. That's what it stands for. Okay, so now we're on to the next section, number 3, FX Outlook, US dollar debasement versus safe haven dynamics. G10 currency forecasts year end. For the euro, it's currently at around 119. Let's check that out. I'm pretty sure that's not true. Yeah, we're currently at 114. And look at that. The euro has had a nice, significant pop here. It's up about 50 pips on the day. And check that out, looking at the range probabilities. You can see this is where the low is likely to come in for the day if you are a bull, especially on the more aggressive side. And this is a peak on the top, where most of your tops for the day come in. So I would not be surprised if that is a top for the trading day, and that was the bottom. We can actually use something called timing dots to try and assist in that. Let's go ahead and set an appropriate setting here. Maybe 0.5. And yeah, the only tops given this low that occur beyond this high are closer to the end of the day. So we would need to see prices continue to rise at a quite steady pace here above 114.80 to see those higher prices. However, it does seem more reasonable for that to likely be the top, unless there is something I have missed and oil does continue to fall like a brick. As you can see on the chart, it is falling like a brick. So if oil continues to fall very aggressively, let's say it goes past this low right here, something like that, then I would definitely expect more US dollar weakness, more risk on, because the countries that are most affected by higher energy prices will have improved expectations from lower oil prices. So let's go ahead and continue. Dollar, yeah. Oh, so the bull case here is to 130 for. Looks like we already experienced the bear case, right? So bull case is 130 for euro dollar, and the bear case is 115. So it looks like, based off the things that this document has read, the euro has already hit this bear case here. I will say this was quite a hit or miss table when I first read it. So I would like to move on to these key drivers for this section. So first, US dollar. And we can go to DXY for this on the chart here. And you can see DXY is also falling alongside oil right now. A temporary safe haven bid from Iran conflict masks structural weaknesses. Fed independence concerns, Warsh nomination, and debt sustainability issues support medium-term bearish view. DXY could retest 2024 lows of 99 by year-end once energy shocks fade. For the euro, and we can go back to the euro USD chart for this one, and you can see how it continues to rise right now as the dollar is weakening right now and oil is falling right now. Still waiting for a confirmation on news for what is causing that. Maybe we can check the Bloomberg front page here and see if there's anything particularly obvious. Trump demand for Hormuz support faces resistance. That is the current front page headline for Bloomberg. Iran war catapults Asia to the front line of a global energy crisis. Trump calls for Chinese warships, hits on sensitive topic for Xi. U.S. allies wary of joining Trump's Strait of Hormuz mission. Iran strikes Gulf oil hub as it rejects Trump's ceasefire claims. Let's see here. Yeah. What is this one here? U.S. stock market is, quote, breathing a sigh of relief, unquote. That oil prices are holding steady after the weekend. Chief market strategist at Jones Trading says. He pointed to the, quote, small amount of recent tanker traffic through the Strait of Hormuz. That's right. There's been, I think, like 3 ships, one to 3 ships that went through the Strait. There is speculation. What I read before getting on the stream today is that there are some Iranian IRGC military cells that are in contact with some of the ships in the Persian Gulf trying to cross the Strait, and they are negotiating prices to cross safe. And it seems like some people are paying to get those ships through and paying the IRGC to not shoot as they cross. We'll see how that holds up as far as reporting goes, if that turns out to be true or not. Quote, thus we have a bounce driven by hedges being covered and mild optimism due to those reports. Well, if that's really what's going on, I wouldn't be surprised to see this as a potential counter trend trade opportunity. It would be nice if this is the start of ships going through the Strait, but if it's only 3 or 4 ships because they did a negotiation, a rumored negotiation, a rumored deal, to pay some IRGC cells to cross the Strait, it doesn't seem like that's going to be wholly sustainable, especially if Trump does rally other countries or is able to send his own ships through to the Strait and continue the bombing campaign in Iran along the coast. We will see how things progress. Things could potentially get a lot safer, a lot faster than expected, but also there's still the nominal, very real risk that this goes on for right now. The consensus is potentially up to May. So roughly sometime maybe in April will things find maybe a stable point. Based off what everyone is saying, my expectation right now is sometime in April, there will be a more consistent flow of ships going through and the Strait of Hormuz. But that's going to require a handful more operations between now and then. So I'm not too sure if this sigh of relief, this relief rally, this bounce, this hedge bounce, this mild optimism being described is something that's going to be the start of a new trend. I don't think it's going to be particularly sticky right off the bat here, considering there are still operations that the United States wants to conduct even just on their own without allies into Iran still right now. Okay, let's continue with the section. Euro, strong manufacturing recovery, German PMIs beating, Euro pound appreciation, Great British Pound, let's check out that chart. Euro pound appreciation to 0.89, and we're currently sitting at 0.86. And hedge ratio adjustments support bullish case. A Euro, or rather ECB hold through 2026 contrasts with Fed cuts, supporting narrowing rate differentials. Now, again, there we go saying Fed cuts. We're about to go into a bunch of central bank meetings. It's very likely that this expectation will not hold as central banks shift their position to holding rates in anticipation of transitory higher inflation due to the operations ongoing in the Gulf right now, to the oil disruptions in the Persian Gulf. Now we have JPY. BOJ hiking to 1% by year-end. Q3 or October meeting is currently expected. But real yield differentials remain negative. Yen depreciation pressures persist. Intervention risk rises above $60 yen. And currently, we have actually fallen close to 100 pips on the day. You can see dollar yen right now. Yesterday's high was 159.75. And today, the low is at 158.96. So it's quite nice to see the move lower in response to the lower oil prices that occurred today, in response to the lower dollar valuation today. It's giving some relief to equity markets and more risk on currencies. Now, let's see here. Takeishi's pro-stimulus fiscal stance complicates normalization. She's working with the BOJ on that. We will see how that progresses going into the summer. We will get more information on that front. Now, Aussie, New Zealand. The RBA, RBNZ policy divergence peaks, with RBA hiking while RBNZ holds until December. Aussie, New Zealand testing 13-year highs, going past 0.9 as possible. And Aussie, New Zealand is already at 120 here, so that doesn't seem correct. I mean, we were before the attack on Hormuz, on Hormuz, before Operation Epic Fury. We were trading around, what's that, 118? 118.6, and now we're at 120. So I'm not quite sure what is going on here of saying 0.9 possible. New Zealand dollar underperforms on housing market weakness and delayed tightening cycle, which is true. New Zealand's performance, I'm very glad it actually picked up on this, because New Zealand's central bank the RBNZ is explicitly concerned about rising housing prices, about housing supply, because there's more pass-through because they have variable rates in New Zealand for their housing. So a rise in inflation in New Zealand can cause more volatility economically for their country. So that's why the RBNZ is watching it a bit more closely. So now we're on to the next section. I was particularly happy to see this brought up. This is number 4, geopolitical risk calendar, critical dates. First half of 2026, event pathway. So for March, ongoing U.S.-Iran war, Hormuz closure, duration critical. So that's for March. It will be ongoing, and you can see all these events out to May. And we have the ECB on March 18th, the BOJ March 18th, the BOE on March 20th, and the RBA on March 25th. Those are when those meetings are. Trump and Xi meet March 30th to April 2nd. Xi will be receiving Trump in China. The UK spring statement already occurred. And in the UK, there are going to be elections in May. German state elections are being held. There was already one in Baden. I'm not going to try and butcher that. And then there's going to be another election in Germany on March 22nd in Rhineland-Palatinate. I'm just going to say the first one for Rhineland. Okay. And then April. Australian federal budget is on May 12th. That will be good to understand the fiscal policy for Australia. That will inform how the RBA may change their expectations for rate paths. And also change expectations for inflation from the government's end of things. UK fiscal policy changes take effect April 6th. First round of French municipal elections were yesterday. We're currently updating the French municipal elections research thread in the Discord right now. And we are currently preparing to do research for the second round due March 22nd. And the municipal elections are important to follow because it is from the municipal elections that electors for the French Senate occur. And whoever is elected, the party representatives elected in the municipal elections, become the electors that vote for their party in the French Senate. And about 95% of electors will vote for their own party in the French Senate. So this is a bellwether for the French Senate election later this year in September. And it was polled 4 out of 10 people who vote in the French municipal election will use the results from the municipal election to determine how they should be voting in the presidential election in 2027. Now, that's just polling. I'm not quite sure how reliable that particular question will be, but the Senate will certainly have a say as to who is going to be a part of the leadership of France. So we will have to follow the municipal elections, the second round here, to see maybe what the likelihood is that we have a national rally leadership taking office sometime next year. And we'll get a better idea of the likelihood of that. And from these first rounds, we actually know that some far-left parties have been getting quite a bit of traction here, especially with younger voters. in France. Again, details will be in the research thread in Discord on that topic. So for May, RBA is expected to hike. You have UK local elections. There's 5,000 council seats, and then the Scottish and Welsh Parliament elections as well. South Australia election. And that's going to be March 21st. Labour expected to win. I don't know why that's over here in May. And then there's also, I believe there was or is an election coming up in Victoria. I think I missed making the thread for that one, but there's another election. There's another state election in Australia that's also upcoming. And then June, you have the Fed meeting. First cut was expected at this meeting. I don't think that's expected right now due to transitory inflation expectations coming in that I think will likely be in the FOMC's, in Fed Powell's, in Fed Powell's speech. ECB quarterly meeting with updated forecasts. Swiss bilateral 3 ratification vote. I believe that's also supposed to happen actually in March, if I'm not mistaken. USMCA mandatory joint review on July 1st. I think a lot of people are... There's a lot of misinformation going about on, oh, how terrible the negotiations are going, or, oh, the United States and Mexico are cutting out Canada from their bilateral negotiations. Well, guess what? Just like 2 days ago, Canada and the United States are having their own bilateral negotiations without Mexico. All 3 of these parties are currently just going through the process in whatever back rooms and officially in trying to come up with an amicable deal for continuing the USMCA. That is all. And as we get closer to this joint review, we will have a better idea of what to expect. This is still a few months away. We will likely get a better idea of this, especially by May and definitely by June. And this is New Zealand fiscal policy update, and then OPEC summer meeting. Gotcha. So tail risks to monitor for this section. Iran conflict escalation, China's rare earth export curbs already implemented, possible Strait of Malacca disruption, and Saudi pipeline capacity only 5.5 million barrel per day alternative. Also, there's fertilizer costs here that are rising. Urea prices are up a lot, and those are likely going to funnel through into farming costs. We'll see if it actually ends up in higher food prices shortly or not, depending on how long and how high urea prices go. Then USMCA failure, Trump threatens termination, US-Mexico face tariff wall, dollar CAD could spike to 150, Mexican peso collapse risk. So that's if this falls apart and the United States is able to tariff Canadian and Mexican goods at rates similar to other countries, how other countries are tariffed. Now, I personally think it's a bit naive to expect that because the United States has a lot of benefits in having Canada and Mexico right next to each other, right at the border. There's a lot of very, very good work in both of those countries. And frankly, it's in the United States' interest to give preference to those 2 countries, manufacturing-wise, over other countries, just because of the proximity of those countries. Now, next point here. Fed independence crisis. Warsh confirmed as chair in May. Powell terms ends. New board nominees shift dovish. Market confidence erosion. This already is kind of an old risk because it was, I believe, just today or yesterday that news was released that the lawsuit over Powell misappropriating, not necessarily misappropriating, but going far, far, far over budget, as Trump would put it, on renovations for the Federal Reserve's buildings and the overruns from the contractor, those were dropped. And the judge dropped them saying that this was a targeted lawsuit against Powell that actually had nothing to do with the cost overruns for the Fed's innovation project. And Trump made a whole post saying he was very upset with the judge deciding to ignore the overruns and to essentially shoot down the case, to say that the case was only for political reasons. And my take is both sides are true. It is political, but those also are real cost overruns. But obviously the judge weighed the political parts much, much greater than the cost overruns part. And so this particular Fed independence crisis risk already in the last couple of days has come down quite a bit. China property sector, despite stimulus, housing investment contracted 17% in 2025. Household confidence is fragile. Growth undershoots 5% target. Well, China just had their 5-year plan meeting. I forget exactly the appropriate name for it, but every so often China gets together and they create a plan, an economic plan for the next 5 years to set economic targets for China. And instead of setting a 5% GDP target, they've now set a 4.5 to 5% GDP target, so they can have some wiggle room. You know, they can target 4.8% or realize their GDP at 4.8% and be just fine, or they can hit 5.2% and be fine. It's when they come under 4.5% that they're not fine. So the growth target, that poll has been moved. Now, election surprises in New Zealand, closed polling in May, reform, Colombia, Brazil, presidential elections, shift right expected. That's right, Colombia, Brazil do have elections where they're expected to shift right. I actually believe some of those elections might already be over, if I recall correctly. Okay, now we're going into the next section here. Commodity and asset class implications. Gold, the ultimate hedge here. And we have some scenario analysis here. So let's pull up gold on the chart. And gold is currently on the day sitting at $5,029, $5,030 now. And so the base case here for the scenario analysis is that gold stays within the range of $4,750 to $5,500 an ounce with about a 50% probability. And then in the bull case is gold trading between $5,500 and $6,250 an ounce with a 35% probability, triggered by prolonged war with Iran or a US dollar crisis, where actually if the US dollar gets really significantly bullish and oil gets to prices above 150, while gold certainly will appreciate, there will be people who do trades where they shift from gold into oil, anticipating higher returns. So there might be a bit of a, you could say, a chilling effect on the price of gold as people move into assets that have more exposure to generate returns from higher inflation. Gold still, I would expect in that scenario to go up, though. In the bear case, in the price range between $4,000 an ounce and $4,750 an ounce, with about a 15% probability, that would be induced by a peace deal with Iran, the end of the conflict, and further dollar strength. We already know that the consensus expectation is not the dollar strength, so it seems more reasonable, an expectation in my mind, that lower gold prices, at least in the short term, would come from a de-escalation with what's going on with disruptions with oil markets in the Persian Gulf. However, with a weaker dollar and potential higher inflation going on here, I would not be surprised to see gold just straight up continue to appreciate. So I would even attribute a lower probability to that bear case there. Let's see here. Let's go on. Supply shocks. Okay, we're on to the next section now. Equities. Stagflation adjustments. In the equity sector, we have energy as the sector. We have the energy sector as an outperformer. Integrated oil names leveraged to higher prices. Services, companies, drilling, and equipment benefit from increased capital expenditure if over $100 per barrel is sustained, which doesn't right now seem to be the case because oil right now is sitting at $95. We just fell from about $101 earlier today twice. A tech and discretionary sector. Underperformers if oil is above 130. Real income squeeze hits consumption. And then European industrials. Mixed. Defense names. The German stimulus beneficiary, primary, versus energy-intensive manufacturers with margins compressed. Again, if the big story I brought up at the beginning of the stream with the $90 billion in military aid to Ukraine is passed, a lot of that money, once it's in Ukraine, will then get spent back into Europe as additional stimulus. And a lot of those same defense names that are receiving money from the German fiscal stimulus are also going to be beneficiaries from this military financial aid package of 90 billion euros to Ukraine. And I was particularly happy to see this chart. I really liked this chart. Major political events and subsequent S&P 500 price returns. And this is a chart from Merrill Lynch. Historical equity performance during geopolitical conflicts is what's described here. Only Yom Kippur War in 1973 caused sustained major damage. Most conflicts, the Gulf Wars and Ukraine most recently, result in temporary dips followed by recovery. So if we go to this row here for the Russia-Ukraine war, or Russia-Ukraine conflict as it says here, the date it started was February, I believe, 24th, 2022, is that the timestamp supposed to be read. On the very first day of the conflict, equities, I believe, S&P 500 prices actually rallied 2%. A month later, they were up 5%. And then 3 months later, they were down 8%. 6 months, 3%. 12 months, negative 7%. And at this point, you have to wonder, are these later months, this 3, 6, 12-month window, really caused by this conflict if the first month was also not negative? You can actually see in many of these, when many of these conflicts began, equity markets rallied, not like 0.5%, but sometimes multiple percent. I believe the single largest one-day negative move out of all these events was the 9/11 terrorist attacks on September 11th, 2001, with a negative return, one-day return, after the event occurred of 4.9%. But 3 months later, markets had recovered and were up 4.3% even after 9/11. Here's the start of Gulf War in the 17th of January, 1991. The first day reaction was positive, 1.3%. A month later, markets, the S&P was up 12.5%. 3 months later, it was up 19%. 6 months later, 16%. 12 months later, 27%. The Arab oil embargo was much more negative. So that was 19th of October, 1973. We had a negative 1% day move. And then a month later is negative 8.6%. 3 months later is negative 13.3%. And then 12 months later is negative 34.4%. It was quite bad after the Arab oil embargo started. And not only that, but inflation jumped really high at that point. And it was from there we had Volcker, I believe, Paul Volcker, come in to try and stamp out inflation by sending rates incredibly high at the FOMC. Oh, look, the Iranian Shah is overthrown here, the 11th of February, 1979. But you can see markets were positive, and then a year later, markets were still up 20%. So this is a nice historical review, and I was very happy to see this because it's a nice little bit of grounding. There's only a handful of geopolitical events that have super significant, lasting negative impacts, especially on equity indices. But also there's usually 2 or 3 other knock-on effects that exacerbate and maintain those negative returns going out 3, 6, or 12 months. Okay, so now we're on to the next section here. This is strategic investment themes. So theme number 1 is policy divergence arbitrage. Long Aussie New Zealand. Long Aussie pound. Australia hiking into resilient economy. UK and New Zealand are cutting or on hold amid slower growth. Yield spreads widening favor Aussie. Well, we just so happen to have an indicator for yield spreads. So let's go ahead and check out our yield spreads here on the day. And so far, things are actually quite negative. We had a nice string of positive trending yield spreads here for about a little under a month and a half, 41 days. And that was about 500 pips move higher. And then it was Aussie, Great British Pound. And this is now Pound Aussie, so we need it flipped. And you can actually see yield spreads are now moving in favor of the Great British Pound right now. After a long period of negative yield spreads from here all the way down to here, we're now starting to see the first major spike in positive yield spreads. This is the entire duration that yield spreads were quite negative or neutral over this period. It was close to a half a year, 176 days, close to 1,700 pips. Wow. The last time we had such significant positive yield spreads here on Pound Aussie was back here, the 20th of August, 2025. So quite a long time ago. We did have this little blip right here back on the 28th of January. But obviously it did not follow through, unlike how these are currently printing nice and green at the moment. So we will have to see how rates change and how expectations at the Bank of England change relative to the RBA. So looking at the contrasting policy between two central banks now, with yield spreads moving more in favor of Pound Aussie, moving more in favor of the pound side of things, it will be kind of important to watch for sure. Let's go ahead and continue. Let's hide this, close that, so we get a nice big fat chart. And now we have theme number 2, energy transition disruption, long oil to gold ratio. Well, there's no ticker for oil to gold ratio. You have to create it yourself. You have to do something along these lines here. And then GC. And this is the oil to gold ratio using futures. And you can actually still see that the ratio is still very, very right now in favor of oil at the moment. When this goes up, oil is strengthening against gold, and when this is going down, gold is strengthening against oil. And effectively since 2022, gold has been appreciating at a fast rate against oil. And hello, nice to see you in the chat. Okay, now we're on to theme number 3, US dollar structural weakness. Long euro dollar, long gold, long US dollar versus short dollar against emerging markets. Despite temporary safe haven bid, U.S. debt dynamics, Fed independence concerns, and twin deficit support multi-year dollar decline. We've already covered this bit here on Fed independence concerns and how those concerns have been alleviated somewhat in the last couple of days, especially with the case against Powell for the cost overruns at the Fed renovations being put off by the judge now. I believe the judge dropped the case. That was the news. The debt dynamics ties in with the tariffs because a lot of the United States tariffs were going towards paying off the debt, and that was helping boost analyst expectations for improved U.S. credit ratings. But now with those tariffs needing to come through other methods, and potentially and likely the refund of the IEEPA tariffs that were collected, it puts more pressure on these debt dynamics that are being pointed out. And then these twin deficits fall into that same category. Theme number 4, European defense / industrial renaissance, which is quite likely to occur. So long German defense industrial names due to the German fiscal stimulus, NATO spending commitments, manufacturing PMIs inflecting positive, which is still occurring. But again, one thing that's missing here is the $90 billion Ukraine military aid package. That needs to be discussed here, and we did discuss that earlier in more depth. And when and if von der Leyen is able to get Ukraine that money, along with all the rest of the European leaders working around Orban, who's currently vetoing the 90 billion euro package to Ukraine, if they're able to get that package through, or let's say Orban does not win his election in April, his opponent wins. I have not actually checked if his opponent would vote yet for that package. I, though, would not be surprised if he did, because many of his opponents, especially Orban's opponents in the Eurosphere, especially Zelensky himself, would prefer his current political opposition to win. So there might be other ways of getting that package, that 90 billion euro military aid package for Ukraine passed. But the ultimate goal economically and for trading purposes for us analytically is if that money gets sent to Ukraine, a lot of that money is going to come back to the rest of Europe and even to the United States to an extent to pay for more defense build out. So while the German fiscal stimulus has been quite nice, this would put a lot of gasoline on the fire for a lot of defense companies throughout Europe and in the United States. And theme number 5 here, LatAm political cycle. Yep, that is currently occurring, but I am not following it all too closely. Although I sure wouldn't mind if someone helped set up a research thread for someone who is particularly passionate about these particular elections that are ongoing. And now we have the next section here, section 7, risk scenarios probability matrix. So we'll go by row. We have a soft landing scenario here with 30% probability. Iran ends the war in weeks. And now we're approaching the first month of Operation Epic Fury being in operation. So we can already discount this section of the scenario analysis, where oil is below $80, the Fed cuts twice, and USMCA is extended. Obviously, equities would rally, the dollar would weaken, and Fed rates would be lower. This scenario is already off the table. We can cross this one out. Stagflation light. And by the way, I'm pretty sure I can literally cross it out. Like, there we go. All right, stagflation light, which is a 40% probability according to this matrix. A conflict lasts 1 to 3 months. Oil is between $90 and $110 per barrel, and central banks remain on hold. Range bound for equities, steepening curves, FX vol elevated. This seems like the primary expectation. This seems like the nominal expectation right now. Then we have the stagflation severe scenario with a 20% probability applied to it in the matrix, where for 3 months plus, we have a closure at the Strait of Hormuz. Ships cannot cross through it. Oil stays above $130, and central banks hike into higher inflation and economic weakness. This would induce a recession, at least in components of many economies, and in many countries, complete recessions throughout their entire economies. Credit spreads would widen, and emerging markets would have a crisis risk. This is also a realistic expectation if things do not resolve in the next 3 months, which effectively take us out to the time frame of May. If things are not resolved by May, inflation pressures become much more serious. And we actually went over that a bit in depth earlier. The final scenario here is the geopolitical de-escalation, with 10% probability assigned to it in the matrix. A peace deal is agreed to, sanctions are lifted, and Iranian oil supply returns. Oil crashes potentially below $60. I don't know if I would be setting that expectation right now. And risk assets surge, Fed front runs cuts. I think this is also an unrealistic scenario. We are going to cross that off the list here. I think the most realistic scenario, and I would assign higher probabilities to, are the stagflation light scenario and the stagflation severe scenario, while first expecting the stagflation light scenario to occur, and then until information realizes, until either the conflict realizes and does actually go on for many, many months into the end of May without a resolution, without more ships crossing through the Strait, then I would assume the stagflation severe result would occur. So now the goalpost has been moved for Operation Epic Fury. Instead of an in and out operation bombing campaign, now it's 1 to 3 months instead of 1 to 3 weeks. It would have sure been nice if it was 1 to 3 weeks, wouldn't it be, guys? Wouldn't it be? But based on how a lot of things are going, I would not be surprised to see something in the middle here, potentially, where the conflict in Iran is ongoing past the 3-month time, but markets and the flow of commodities through the Strait of Hormuz and into the Persian Gulf and out begins to the process of normalization. So I have a mixed expectation on that front that I don't see very many other analysts have. And I went over that also in more detail earlier. So this is a chart. What level do you expect the S&P 500 to end in 2026? This is from S&P Global Investment Manager Index. 38% of fund managers expect the S&P 500 to end 2026 between end 2026 between 7,121 and 7,620. The median expectation is around 7,500 on the S&P 500, suggesting confidence in post-conflict recovery by the end of the year. And this is an escalated disruption scenario analysis of inflation between the United States, the Euro area, and Sweden. Let's see here. With oil at about $100 per barrel and TTF gas at roughly 100 euros per megawatt hour and 50% plus electricity prices, headline CPI for these countries peaks at around 10 to 11% for the Euro area, versus the 2% baseline, demonstrating severe stagflation risks. Yeah. It doesn't look like, no. 10 to 11% is actually an incorrect interpretation. They're looking at these 2022-2023 metrics, when the scenario analysis is over here to the right. And the scenario analysis is actually pointing out that the euro area could induce closer to 4% inflation over the rest of 2026 into the end of the first quarter of 2027 before normalizing. And that the United States could see inflation in the high 3 handle for CPI for the rest of 2026, also into the end of the first quarter 2027. And Sweden would actually see quite a bit of disinflation, not negative inflation, but disinflation going into the first quarter of 2027 from about 3%, just under 3%, to around 1% by the end of the first quarter 2027. Now we're on to the next section here, section 8. Key data points to monitor for the week. Hormuz tanker traffic volumes, U.S.-Iran negotiation headlines, and oil inventory builds. I'd also add that watching the amount of missile, drone, and ballistic missile strikes from Iran, and also Iranian internet connection outages. If the internet connection in Iran comes back on, and if the number of drones and ballistic missiles launched from Iran is as close to 0 as possible, that also assess as a data point to watch for escalating or de-escalating tides for the disruption in the Persian Gulf. For the month, we have flash PMIs, manufacturing input prices, new orders, and employment. Inflation expectations, central bank speeches as well. I agree with all 3 of these points. These are things absolutely to watch, because all of these will have discretionary commentary on what to expect potentially for the next couple of months and where people currently stand going into potential escalatory risks of higher oil, higher inflation prices. Jobs growth is found at base. So I believe this is jobs growth for non-farm payrolls. Gotcha. And then quarterly, we have some central bank meetings, Fed, SEP, which is due when here during March, and OPEC plus production releases. This is the last dot plot we got from the FOMC in December 2025. And you can see that we were expecting rate cuts going into 2026. I'm expecting this to effectively be a flat line. So instead of this line here, I'm expecting something along the lines of, let's use green here, of effectively flat. Maybe something like this. But I am expecting flat, or maybe 1 cut expected in 2026. ECB inflation shock scenario. We actually already looked at analysis around this. Taylor rule estimates suggest that if oil shock persists, ECB may need at least 2 rate hikes compared to the current 2% rate. Contrast with Ukraine crisis, rates were accommodative then, now neutral. So that's actually quite nice to see that analysis. So now we're on to the final section, the conclusion. the year of divergence. 2026 marks a regime shift from synchronized global monetary policy to divergent national trajectories. Australia's inflation fight, Japan's cautious normalization, and Canada's recession risks exemplify the fragmentation. And all of these things are right now in flux with oil prices around, especially how bad Canada's recession might be depending on oil's appreciation. Continuing on, the Iran conflict has introduced a stagflationary wildcard that could either resolve quickly following a soft landing narrative to resume or persist, forcing central banks into painful trade-offs between growth and inflation credibility. And we can still see oil giving markets a bit of relief right now, coming down to $94 from 101. It tapped 101. Actually, it tapped 102 here at the beginning of the day, and then it retapped 101 just about 8 hours ago. And now going into the New York Open, a little bit past the New York Open now, we're at $94.55 currently. So this is giving the markets a bit of reprieve. And continuing, the US dollar debasement theme remains valid, but its timing depends critically on Hormuz reopening. Until then, the dollar trades with a risk premium that masks underlying structural weakness. Gold and the Swiss franc remain the cleanest hedges against both geopolitical chaos and fiat currency concerns. And if we look at the dollar Swissy, you can also see that the Swiss franc has been gaining against the US dollar. And one of the things that actually was hurt quite a lot for a while here was the Swiss franc. You can see from the beginning of the year, especially after Operation Epic Fury began, the Swiss franc has been taking quite a beating. But now, rate hike expectations are starting to form at the Swiss National Bank, the SNB. So we'll see if these higher prices hold for the dollar and the Swiss franc. It doesn't seem like, depending, again, if the conflict ends and the disruption of commodities through the Persian Gulf, through the Strait of Hormuz, comes to an end sometime in the next 3 months, that we will, I think, end up seeing lower prices here for the dollar Swissy. Okay. For the second half of 2026, expect volatility around the, quote, last mile of inflation, terminal rate, uncertainty high. The transitory inflation theme will also take effect around here. Definitely a lot of people will be discussing transitory inflation as a theme for the second half of 2026. If assuming commodity normalization in the Persian Gulf. And then for FX, US dollar weakness resumes in the second half post the conflict. JPY intervention risk, euro appreciation. For commodities, oil mean reverts lower. Gold establishes new roughly 5,000 equilibrium. I don't necessarily agree on the gold equilibrium. I'd actually expect continued appreciation of gold going forward. And then geopolitics, USMCA as the next flashpoint after Iran. Election cycles in New Zealand, UK, Latin America. And in Germany and in France. There's a lot of elections to watch that will have quite significant market impacts that we have research threads for in the Discord. The baseline remains constructive, but confidence intervals have widened dramatically. Position for divergence, hedge tail risks, and prepare for a multi-speed global economy. Okay. We are done with that big fat note, everybody. Let's get a round of applause, some claps, some congratulations. We are now done. That was a 2-hour stream. For the last 2 weeks, I've been back streaming every single day, and this has certainly been the longest stream that I have done since coming back and doing streams. Man. And it was just going through research and pulling some stuff up on some charts and updating our expectations as we read some of that stuff. Now, hopefully that information was quite useful to you guys. I will now be in the Discord going over, hopefully, if Ari's still awake and willing to go through it, some Aussie charts and some research trade plans for Aussie currency pairs. And I mean, I really do look forward to seeing more people in the chat in the future. I look forward to seeing more people in the trading group. I look forward to seeing more people in the research threads. And I am so ready to now take a little break after a 2-hour long stream. I think it is very successful. I think I'm going to have a great highlight stream video for this stream and some great shorts clips out of this for sure. Okay. I'll see you guys in a bit. I will see you guys in the Discord and looking forward to seeing more of you guys around. All right. In a